The reason I'm recording this today and sending it out to each one of you is simply because the office is closed a half day today, and wanted to give everyone a chance to look at this on their own time instead of coming in. So you all got this in an email, and it's just being played over YouTube. So I want to wish everyone a happy Independence Day, and wanted to talk about cash flow statements this week. We've been talking about balance sheets. We've been talking about our profit and loss statements. I've been giving you terms, a little bit of homework. Your homework from last time that we had spoke 2 weeks ago was to actually look at your balance sheet of your own business so that you can actually understand it on your terms. So today we're going to look at cash flow statements. And this is just for a couple of minutes here, and recorded it so you guys can watch it back again. And I'm also going to send this stuff out to you. So cash flow statements, and I want to apologize for last week. I was on vacation down in San Diego, and so I just want to apologize. So cash flow statement, when you're learning to read your financial statements, cash flow statements probably the most important sheet in your small business papers because it actually keeps track of the money that you actually have to spend. And keeps track of your cash, basically, yeah. Remember that you can be profitable, but without necessary cash, your business is in serious trouble. You can spend your earnings, otherwise known as your paper profits, but you can only spend cash to fund your operating capital. A lot of you, I've looked at financial statements, and if you actually just look at your profit and loss statement, it shows that you're making money. But then I say, let me see your cash flow statement, and it shows that I've got money coming in, or I've already spent that, or I had somebody else that I had to give money to, and the money, it shows that your company made money, but it doesn't show that you have any money. And I think all business owners have been in that dilemma on occasion. So good cash flow management means a lot of different things. A couple little strategies is delaying your payables as long as you can while speeding up your collection of accounts receivable money that's owed to you. You are not a bank, and everybody expects to get paid immediately, and I know I talk to the franchisees and actually a lot of business owners that I work with always pay their bills on time or the first day that they can. I always ask them why. I said, you must be the bank. I said, because they're pulling everybody out 30 days to pay them, or 45 or 50 or longer, but they're making you pay immediately. So good investment strategy. The cash flow statement accounts for collections, inventory paid, any fixed asset investment, and expenses paid. This is why some of your vendors don't pay you immediately. Now we say you're 30 days out. Well, they could pay you immediately, but they're holding their people out longer than they expect people to do it. So it's just a good cash flow strategy. Learning how to read this financial statement is really not difficult. The cash flow statement's the easiest of all of them. Most people avoid it just because of this reason, as maybe they don't have any cash or they're low on cash. But once you understand this basic concept on how to read the financial statement, you'll be on track to build a really good company. So a couple of terms I want to go over real quick here. First one is earnings. Earnings are simple. It's just your total input, your total income minus total expenses. And you can look at that as synonymous with your profit. Depreciation is a method to account for assets whose value is considered to decrease over time, like a vehicle. You buy a vehicle, a used one for $10,000. Most companies or most accountants and tax companies will let you, use 3 to 5 years to actually depreciate the value of that. But that's money that you can actually write off. I'll show you what I mean a little bit later here. Capital spending, spending on items that have a useful life. Most of that is equipment. Can also be known as additions to property when you're looking on your cash flow statement. So a couple notes here. There's 3 sections to most cash flow statements. There's the operations, financing, and there's the investing portion of it. The first 2 sections show the 2 ways the money can get cash. The company can get cash. When it talks about operations, it means making money by selling your goods or services. financing means raising money by issuing stocks and bonds. The third section of the company, being the investing, it's all about investing in the future growth. If you're interested in the stock of a company, you'd like to see that they can pay for investing, figure out of the operations figure without having to turn to financing. So sometimes financing can cause problems while you're issuing new stocks. Usually what that will do is lower the value of each individual share. So hope everyone understands that. I wanted to quickly talk about cash flow versus income. It's important to note the distinctions between the two, being profitable and having positive cash flow transactions. Just because a company is bringing cash does not mean it's profitable, and vice versa. And here's just an example that I made up here. Say a manufacturing company is experiencing a low product demand and therefore decides to sell off half of its factory equipment at liquidation prices. It will receive cash immediately, right at this particular moment, from the buyer for the used equipment. But the manufacturing company is definitely losing money on the sale because they sold it for less than it's worth. It would prefer to use the equipment to manufacture products and earn an operating profit. If they want to grow, they're going to have to buy that equipment again. But since it cannot, the next best option for this particular owner is to sell off the equipment at prices much lower than the company paid for it. In the year that it sold the equipment, the company would end up with a positive, strong cash flow, but its current and future earnings would be fairly bleak. I hope that makes sense to everyone. They'll have cash because they sold the equipment, so they'll be able to pay everybody. But the following year, when they want to grow and it starts picking up again, they're going to have to invest in capital. Because cash flow can be positive while profitability is negative, investors should analyze income statements as well as cash flow statements, not just one or the other. Okay. When you look at a cash flow statement, the first thing you should look at is the bottom line item that says something like net increase/decrease in cash and cash equivalents. The reason for it, since this line reports the overall change in the company's cash and its equivalents, the assets that cannot be immediately converted into cash over the last period. If you check under current assets on the balance sheet, you'll find cash and cash equivalents. If you take the difference between the current cash and cash equivalents and last year's or last quarter's, you'll get the same number found at the bottom of the statement of the cash flows. So basically, this is just a consolidated financial statement or the cash flow statement. So like I said before, that's usually the most important of all the financials is, do I have cash or don't I? And so go over these three little sections that I told you. So the first one is the cash flow from operating activities. In this particular example, they did $83,000 in business for this month or this quarter. But the cash paid to suppliers and employees was $56,000. So the cash generated from operations was $27,000. There were also some other monies that were brought in, a little bit from dividends received, interest received, interest paid. It's $500, so there's a wash right there between the $500 positive and the $500 negative. And then out of that $27,000, they had to pay taxes, nearly 10%, about 9.5%, which is that $2,450. So the difference between the two of those is $24,800. The next section down is the additions to equipment. In this particular example, it looks like they paid $2,500 for some piece of equipment, and then another one is they had additions to equipment, may have just been fixing the equipment or upgrading it, and then another $7,000 to replace of old equipment. It looks like they sold some of that equipment, but they only made $500 from that, and so the difference between the $9,500 and the positive $500 in cash flow is $9,000. So there's some other cash flow from financing activities. In this particular examples is it looks like they put in $3,400 of their own money into it. They also got a loan for $16,000. There was a $5,400 on payment to loan, so there was a positive variance of $13,000. So if you look at the bottom, that $28,800 is the difference between this $24,800 minus the $9,000 plus the $13,000. That's where that $28,800. So at the beginning of the cash period, they had $24,030. At the end of the cash period, they've got $31,230. So the way you use this is you look at that bottom line and you predict, what am I going to be using for the next couple of months? What are the payments that I got to pay to taxes? What do I have to? Is there going to be enough money so that I can continue to operate? Too many owners do not spend enough time on this particular, the cash flow statement. A lot of times just because cash is low and they don't like to look at it, it depresses them. And so that's the reason they don't want to look at it. So that is our little webinar today, and it's recorded. I'm sending it off to everyone right now, and so you guys will all have this. Just a couple minutes, but by the time you are looking at it, you already do have it here. So if you have any questions, please give me a call, and I'll answer them and I'll send this out to John or to Lydia, and she'll send it out to the rest of you. So have a great 4th of July, and please call me. Your homework for this week is to read your own cash flow statement. If you have any questions, call me on it. So the last 3 webinars that we have done have been on your profit and loss statement, your cash flow statement, and your balance sheet. By this time, you should start getting a good grasp on what each one of those are, what the terms mean, and what they look like for your own business. So, guys, have a great weekend. Talk to you soon. Thanks.